Welcome back to the deep dive. We were actually thinking about you when we were putting today's material together.
We definitely were.
Because you're a lifelong learner, you already know your way around the financial world, you love those aha moments, and you want to get to the absolute bottom of complex topics without needing a dictionary of academic jargon just to get through the first page.
Right. Nobody wants to read a textbook for fun.
Exactly. So today we have an incredible mission. We are taking two radically different sources that, surprisingly, complement each other perfectly.
It's a really fascinating pairing.
On one side of the desk, we have a highly technical 2022 mathematical research paper by Xavier Brouty and Brouty and Garcin. It is titled A Statistical Test of Market Efficiency Based on Information Theory.
Very dense, very academic.
Oh, extremely. And then on the other side of the desk, we have excerpts from Stock Investing 101 by the Young Investors Society, which is this practical, grounded guide to the foundational philosophy of legendary value investors.
It is a stark contrast in methodology. I mean, we are looking at dense, cutting-edge probability theory on one hand, and the foundational, almost philosophical framework of people like Warren Buffett on the other.
And our mission today is to bridge that gap. We are going to connect high-level calculus and information theory directly to practical investing to answer the ultimate financial question. Can you actually beat the stock market, or is it all just a lucky coin flip?
That is the million-dollar question, literally.
Okay, let's unpack this. Let's start with a mental model from the Young Investors Society source. It's a foundational test to determine time preference, and I'll pose it to you, the listener. Would you rather have $100 today or $100 next year?
Anyone who understands basic economics knows that choosing the $100 today labels you a spender.
Right.
You shouldn't wait if you aren't compensated for your patience. Believing that making a sacrifice today can offer you something significantly more than that $100 tomorrow, that is the core mindset of an investor. You are demanding a return for your time and your delayed consumption.
And to illustrate the sheer scale of what that delayed consumption can achieve, the source uses the example of a 20-year-old fireman. So he has a meager starting salary, but incredible discipline.
Which is key.
He decides to save just $1,000 a year for 50 years until he retires. Now, if he puts that money under the mattress, meaning a 0% return, he ends up with exactly $50,000.
Zero growth and heavily eroded by inflation. It's actually worth less.
Right. It's losing purchasing power. But if he invests in something stable, like bonds or real estate, which historically track inflation at about a 3% return, he ends up with $116,000 after 50 years.
It's an improvement.
It is, but hardly life-changing wealth for half a century of discipline. But if he puts that same $1,000 a year into the stock market, which has a historical average return of roughly 9.8%, he retires with $1.35 million.
The jump is just massive.
And it gets crazier. If he manages to learn the skills to actually beat the market and secure a 20% annual return, that exact same $1,000 a year turns into an astonishing $109 million.
It sounds made up, but the mathematical force behind those numbers is what Albert Einstein famously called the eighth wonder of the world: compound interest.
Yeah.
The text highlights how time is the ultimate multiplier here. If our fireman delays his strategy and doesn't start saving until he is 40 years old, assuming that 9.8% market return, he retires with about $190,000.
A huge drop.
Exactly. Had he started saving that exact same amount at age 15, he would retire with over $2.2 million. Time does all the heavy lifting.
And those numbers inevitably spark a massive debate, which the source text highlights by taking us back to 1984 at the Columbia Business School. There was this legendary debate between Michael Jensen, an academic who argued that stock picking is purely a coin flip, and Warren Buffett.
Jensen's argument makes intuitive sense to a lot of people. He argued that if you put a massive room of people together flipping coins, someone is going to flip 50 heads in a row just by pure statistical luck, and we mistakenly call that person a financial genius.
Just survivorship bias.
Exactly. But Buffett's counter-argument addressed the statistics head-on. He pointed out that if you investigated that massive room of coin flippers and noticed that a disproportionate number of those lucky winners all came from the exact same small town or used the exact same technique, you would immediately investigate the technique.
You want to know what's in the water in that town.
Right. And Buffett demonstrated that the most successful investors consistently beating the market Almost all shared the exact same value investing philosophy originally taught by Benjamin Graham and David Dodd. They were following a very specific logical framework.
Which brings us to a really fascinating paradox. Because if the market is a wealth-building machine governed by logical rules over the long term, why does it crash? Why do we see such intense volatility? The text uses General Motors to illustrate this. In a single 52-week period, GM stock fluctuated between $28 and $39 a share. That created a $17 billion difference in the total valuation of the company.
A massive swing.
Yet the underlying business of selling trucks and cars didn't fundamentally change at all during those 12 months.
If we connect this to the bigger picture, we have to look at the psychological framework Benjamin Graham created to explain this volatility. He called it Mr. Market.
I love this metaphor.
It's brilliant. Imagine you own a business with a partner named Mr. Market, who suffers from wild, unpredictable mood swings. One day, he is entirely euphoric, convinced the future is flawless, and he offers to buy your half of the business for an absolute fortune.
Right, a completely irrational premium that ignores the actual revenue of the business.
And the danger is that the very next day, the macro environment shifts slightly. It's raining, he is depressed, and he comes to you in a panic, offering to sell you his share of the business for pennies on the dollar.
The fundamentals haven't changed.
Exactly. The fundamental cash flow of the business hasn't changed from Monday to Tuesday. Only Mr. Market's mood has changed. The value investing philosophy is simply the emotional discipline to wait until Mr. Market is deeply depressed and then buying his assets when they are mispriced.
But to exploit that mispricing, you have to actually calculate the intrinsic value of the asset. You have to know what it's worth. The text gives a really straightforward breakdown using Apple.
Let's hear it.
So imagine Apple sells 200 million devices at $1,000 each, with a $200 profit per device. That is $40 billion a year in pure profit. Valuation essentially becomes an exercise in forecasting the future of those profits.
Right. If you build a model assuming Apple can grow those profits by 5% every year forever, the total future value of the company becomes $675 billion, which breaks down to about $111 a share.
But those assumptions are incredibly fragile, because if they stop growing completely and sales just stay flat, the value drops to $391 billion, or $64 a share. And if new competition enters the space and forces them to cut their profit margins, the value plummets to $220 billion, which is just $36 a share.
This extreme variance is exactly why Benjamin Graham insisted on a margin of safety. Predicting the future is inherently uncertain.
You never know.
You don't know if Apple will hit that 5% growth or lose their margins entirely. If your model says the stock is worth $111, you do not buy it at $110. You wait for Mr. Market to panic and offer it for $50.
So that discount is your protection.
That mathematical discount is your literal shield. Even if your growth predictions were wildly optimistic, the discount protects your principal investment.
Here's where it gets really interesting. We have this clean, logical framework for finding mispriced assets. But there's an entire wing of academia, championed by figures like Eugene Fama, that says finding these mispriced assets is statistically impossible.
Which brings us to our second source.
Yes, the 2022 mathematical paper by Brouty and Garcin. Because if value investing works, how do we reconcile it with the efficient market hypothesis?
Well, we have to define it first. The efficient market hypothesis, specifically weak form efficiency, dictates that current market prices instantaneously reflect all information contained in past prices.
Meaning the past tells you nothing about the future.
Exactly. If this holds true, past price trends offer zero predictive power. The market moves like a random walk. This means statistical arbitrage's reliable windows where an investor can consistently predict the next move and beat the market should not mathematically exist.
So how did academics traditionally test if this was actually true in the real world?
Historically, they used tools like the Hurst exponent and models based on fractional Brownian motion. These are very complex mathematical ways to measure if a time series, like a stock's price history, has long-term memory or momentum.
But the paper points out a massive flaw in how those old tools were applied to the stock market, right?
A fundamental flaw. Those older models rely on highly specific mathematical assumptions. They basically force the chaotic, real-world data of the stock market into neat, theoretical bell curves.
Gaussian distributions.
Right, but the financial markets simply do not behave like perfect bell curves. They have extreme outliers, fat tails, crashes. Measuring the market with tools that assume perfect symmetry will always yield flawed results.
So Brouty and Garcin recognized this and just threw out the rigid models entirely. They turned to information theory, specifically building on something called Risso's method. I'd love for you to break down how they managed to analyze the market without using those old rigid structures.
They knew they needed a model-free approach. To get it, they stripped daily price movements down to a simple binary code. If the price of an asset went up from one day to the next, they recorded a 1.
Right.
If the price went down, they recorded a 0. By doing this, they converted the continuous, messy price graph of an asset into a clean, binary string of ones and zeros.
It's such an elegant solution, but once you have this massive string of ones and zeros, how do you actually measure the difference between a perfectly efficient market and the real world?
That is where they applied Shannon entropy. It's a foundational concept from information theory used to measure the amount of uncertainty or noise in a system.
So how does that look in practice?
To conceptualize this, think of a coin toss. If a market is perfectly efficient, the chance of the very next price movement being a 1 or a 0 should be exactly 50-50, regardless of what happened the day before.
A perfectly fair coin toss.
Exactly. That perfectly fair coin toss represents maximum uncertainty. And in information theory, maximum uncertainty equals maximum entropy.
I see. So if the market has hidden patterns or memory, the coin toss isn't fair anymore. It's a rigged coin, which means the uncertainty drops and the entropy drops along with it.
That's exactly the mechanism they used. They created a formula called a market information indicator.
Which does what?
This indicator calculates the exact mathematical difference between the theoretical maximum entropy of a perfectly efficient 50-50 market and the actual entropy they observed in the real-world binary string. In a flawlessly efficient market, that difference should be 0.
But I imagine dealing with real-world data means you never actually get a perfect 0. There has to be some kind of statistical noise just from looking at finite sample sizes over a specific time frame.
Yeah, sorting the signal from the noise is the heaviest mathematical lifting in the paper. Just because the indicator shows a slight deviation from 0 doesn't guarantee the market is inefficient. It could just be background variance.
Right.
To solve this, the researchers mathematically proved that their estimator asymptotically follows a gamma distribution.
Let's make sure we clearly define that, because a gamma distribution sounds like something out of a physics textbook. But it is the filter that makes their entire test work.
Definitely. A gamma distribution is essentially a statistical curve used to model waiting times and random background noise. Think of it like knowing exactly what the mathematical frequency of static on a radio sounds like.
So once you know the static, you can hear the music.
Exactly. Because Brouty and Garcin proved that the normal random noise of finite market data perfectly fits this gamma distribution curve, they could easily identify when an actual signal, a true market inefficiency, started playing through the static.
That's brilliant.
It really is. It allowed them to build a concrete statistical test with strict 95 or 99% confidence levels. They weren't just observing anomalies. They built a tool to definitively reject the efficient market hypothesis.
So what does this all mean? They took this newly forged mathematical test and aimed it at real-world financial data from 2021. And they used a rolling 100-day window, allowing them to see how efficiency shifted and changed over time. The empirical results they published are staggering, and they directly impact how you, the listener, should structure your investing strategy.
The breakdown across different asset classes reveals a lot about market mechanics. They started by testing the Russell 2000 index, which tracks 2,000 small-cap American companies.
And what did they find?
Across the entire testing period, the test could never reject the efficient market hypothesis for the Russell 2000. That broad index behaved as a perfectly efficient, unpredictable entity with maximum entropy.
Completely bulletproof. Yet, when they took a microscope to the data, things changed dramatically. They ran the test on a single stock called Proficient, which is actually a constituent company sitting right inside that very same Russell 2000 index.
And the results were totally different.
For Proficient, the test rejected the EMH 57% of the time at a 95% confidence level.
Moving to international data, they tested the CAC 40, the benchmark index for the French stock market containing just 40 major companies.
Let me guess. Inefficient.
The CAC 40 proved to be incredibly inefficient, rejecting the EMH 60.8% of the time.
Wow. And then we have the ultimate wild card. They tested Bitcoin against the US dollar. Despite its reputation for wild, irrational volatility, Bitcoin was remarkably efficient.
Completely counterintuitive.
Right. The entropy test only rejected the EMH 4.2% of the time. So why is a broad U.S. index highly efficient, a French index highly inefficient, and Bitcoin practically a perfect random walk?
The analysis points directly to aggregation and the underlying structure of the markets. When you aggregate 2,000 companies into the Russell 2000, all the individual pricing errors, the moments where Mr. Market is irrational about specific companies, they all cancel each other out.
So the noise at the micro level creates efficiency at the macro level.
Exactly.
The inefficiencies are still there. They are just buried under the weight of the index.
Yes. Drill down to individual stocks like Proficient, and you find the pockets where the mood swings haven't been smoothed over.
Makes sense.
And the French index, the CA Soon-for, only has 40 constituents compared to 2,000. So it lacks that massive smoothing effect, allowing structural inefficiencies to remain visible and exploitable.
What about Bitcoin?
As for Bitcoin, its efficiency is likely driven by the sheer volume of high-frequency trading algorithms and arbitrage bots operating 24/7. They are instantly consuming any mispricing the second it appears.
Which brings our two sources together in a profound way. The advanced information theory literally proves that the market is not universally efficient.
Right?
Pockets of irrationality, measurable drops in entropy actually exist. This means the Young Investor Society's 7 golden rules aren't just folksy wisdom. They're practical, behavioral frameworks designed to exploit the exact mathematical inefficiencies Brouty and Garcin isolated.
Let's filter these classical rules through the lens of our new entropy data.
Let's do it. Rule number 1 is think long-term, which the text calls time horizon arbitrage.
And looking at the researchers' 100-day rolling windows, we see that inefficiency is dynamic. It opens and closes. Thinking long-term allows an investor to ride out the periods of perfect efficiency and capitalize when the statistical variance swings in their favor.
Perfect. Rule number 2 is buy good companies, specifically businesses with economic moats. This connects perfectly to the Apple margin decay example we discussed. A moat is what protects a company's profit margins from competitors, ensuring the intrinsic value calculation you make today holds up 10 years from now.
Rule number 3 is demand a margin of safety. We saw that individual stocks like Proficient experience significant drops in entropy, meaning they're highly susceptible to Mr. Market's irrational mood swings.
Right.
The margin of safety is your mathematical shield against that specific, proven volatility.
Rule number 4 is do your own homework. You can't just buy a French index fund blindly. The data proves that structural inefficiencies exist in different markets, like the CAC 40, but you have to understand the specific mechanics of that market to know why the mispricing is happening.
Rule number 5 is don't follow the herd. Warren Buffett says to be fearful when others are greedy and greedy when others are fearful.
Classic.
When the herd panics, they create the very inefficiencies our mathematical indicator detects. Doing the opposite of the herd is how you buy the mispriced assets.
Rule number 6 is diversify correctly. The Young Investor Society text points out a fascinating statistic. Owning just 20 uniquely positioned stocks gives you about 90% of the benefits of diversification. I know that sounds incredibly low compared to holding an index fund with thousands of stocks.
It sounds counterintuitive until you look at the Russell 2000 data. If you keep adding stocks past that optimal 20 mark, you aren't protecting yourself anymore. You are just recreating the Russell 2000.
You become the index.
Exactly. You are actively smoothing out your own edge and burying the individual inefficiencies under the weight of over-diversification.
Rule number 7 is never stop learning. Market structures shift. The algorithms trading Bitcoin today might be trading the CAC 40 tomorrow. Intellectual humility is required to recognize when your edge has disappeared.
And finally, the text offers a bonus rule.
Oh yeah, when you make a lot of money, give back to the world. Applying your wealth to solve real problems is the ultimate return on investment.
A great philosophy.
We have covered immense ground today, from the compounding mechanics of a 20-year-old fireman's savings to the high-level calculus of Shannon entropy and gamma distributions.
It's been a journey.
The data prove the market isn't a flawless machine. Mr. Market still throws his tantrums, and those tantrums can be mathematically identified. By marrying the rigorous logic of information theory with the emotional discipline of value investing, being truly well-informed becomes the most lucrative asset you can possess.
This raises an important question. We now have cutting-edge, model-free information theory that can pinpoint the exact rolling windows when an asset becomes inefficient. But consider the life cycle of statistical arbitrage. As these precise mathematical tools become widely published and inevitably adopted by quantitative hedge funds, those algorithms will rush to exploit those newly discovered pockets of low entropy. Will their collective automated actions eventually consume the very arbitrages the math was designed to find? We may find ourselves navigating a profound paradox where the absolute perfection of our predictive models ironically leads us right back to a perfectly efficient market where no one can win.